Hi there, everyone, and welcome into this week's market update. Now, don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances, and you need to decide for yourself whether it's appropriate to you. Okay, so as usual, let's get started on the chart of the XJO, which is the top 200 stocks of our market. And you can see here, really not much has changed since we spoke last week. We're hanging around this sort of 66 level, and we're still hanging around there now. So this is heavily consolidating. Okay, there's no trend. It's just whipping around sideways in a range. Quite similar price action being seen across other marketplaces like the US and around the world. So not a lot happening. It's almost like the market's waiting for something. It's waiting for that next catalyst to drive it either higher or lower. So all in all, though, market's in a bit of a downtrend. We've got lower peaks, lower troughs overall. And basically, at this point of time, we're really not near any of those extremes. So the medium-term trend being down, we're kind of away from the downtrend line and away from that main support for now. So as we edge into that triangle pattern, we'll be looking for a breakout if it doesn't happen sooner. Otherwise, let's get across to the US market. Okay, so S&P 500 at this point of time, similar sort of price action, like I said before, just whipping around sideways. But the difference is they're actually squeezing to the edge of the triangle, so they are looking to break out shortly, and we'll see which way that breakout is. But really, what I'm focused on is the breakout of the support at 37.50 or the resistance up here at 39.50. So I'm looking for the channel to break one way or the other, and we'll see what happens. I guess we got a question now whether this is the bottom. Okay, we are starting to get multiple touch points along a level, but I really can't call it yet, guys. Okay, can't call it yet, but yeah, we're definitely squeezing, definitely consolidating. There's a lot of key levels around here, so there's definitely an argument of further sideways movement to be had around here. At this point of time, guys, I think we'll find a bottom soon in the next few months. And I actually don't think we'll probably fall off much more than what we already have. And if anything, as you know, 3,500 is my next level that I think will hold, which is about 10% approximately away from the recent highs. So if we're going to go for another correction phase, guys, 3,500 is on the table. 3,500 is also the 200-week moving average. It's also a key Fibonacci level, and it's also the target that got put up using this head and shoulders pattern up the top here. So 35 is my level I've been calling for a while now. And yeah, I'm just kind of just waiting. We're in limbo right now. I'm just kind of waiting to see whether that's going to play out or not. And then once we hit 35, then there's another level of analysis we'll be doing at that level to really ascertain how bad this is going to get. So yeah, look, 35 is key for me in the longer run. In the shorter run, it's this channel. I want to see which way that's going to break. That could take days, weeks, or months. We just never know with these sideways movements. They can last a very, very, very long time. So what's the market waiting for? Well, it could be a number of things, but for now, I think the market's waiting for the Fed announcement and the GDP reading late next week. So you'll have the Fed Thursday morning, Australian time. Okay, so as the Australian market opens, we'll be opening to react to what the Fed has done, maybe 2 to 3 hours before. Maybe a bit longer than that. I think it's like 4 in the morning, something like that. All right. So we'll have the Fed first thing that morning. Okay. Then our market will open and react to that. But then that night we'll see GDP reading. Okay. So this is an interesting one. Okay. So we've got Q1 GDP growth negative. If we have Q2, which is being announced next Thursday night, if that's also negative, that's an official recession. So, the interesting thing is, guys, the Fed's likely to lift rates by at least 75 points. Okay, a full 1% was on the table. They're kind of backpedaling away from that at the moment, but 75 points are still on the table, and that's going to take the Fed up to around 2.5% overall. So, that's that 2.5%. It's getting closer and closer to the bond market. Okay, the 10-year bond, is just below 3, and when you start looking at the shorter term bonds, they're all around sort of high twos to low threes. Okay, so we're getting closer and closer. The Fed's official rate is getting closer and closer to the bond market. But what's really obscure here, guys, is we're going to see the Fed lift rates, and not just lift by 1/4%. We're going to see them lift by 0.75% next week. And if we see recession the next morning, that's not a good sign for markets, guys. It really isn't. So if the Fed comes out of this meeting still signaling that they're going to lift rates heavily come September, and we see a recession come that next morning, there could be some volatility in the markets here. Okay, so just be wary, guys. Like, even though we're seeing a very calm market, it seems like it's waiting for the next piece of the puzzle. And this next piece of the puzzle, Thursday, Friday next week, could drive the markets up or down. Consider a considerable amount. So just be wary of this coming into next week. Now, commodities, as you probably already know, across the board have been crashing since the last Fed meeting. Many of these commodity futures markets have fallen more than 25, 30, and in some cases about 35%. Almost across the board, okay? At least the main commodities that have lifted from the Ukraine-Russia situation have corrected, other than some of the energy space. So a lot of the agricultural futures like wheat, oats have come back down to pre levels, well, pre sort of January levels, which is a massive correction, and should hopefully help take the pressure off inflation. The big thing, though, that still hasn't come down enough is crude. So crude's still hovering around $100, has been lower than this in the recent months that have passed. And a lot of those gas prices, depending on which gas futures contract you look at, haven't really corrected just yet. So the energy space still could hold high for quite some time. But what we're seeing is metals and agricultural prices have come down considerably. Okay, so we're seeing obviously the local miners have crashed off. I can't see the bottom of that yet, guys. Okay, looking at the charts, we saw some strength come in yesterday, but I think with the looming GDP reading next week, that's the one we've got to be looking for. If the US avoids recession, then you might see a nice strong rally through the commodity space, which is positive for the miners, positive for value stocks, but it's going to be negative for the whole inflation narrative. So, we've got to sort of think narratives at the moment. The current narrative is that people believe inflation's has likely topped out. We've seen commodity prices come off quite a bit, and we're seeing inflation expectations fall, even though we're not seeing that flow through to actual CPI just yet. And that's on the back of the commodities correcting and the potential recession. But if the US isn't in a recession, you have half a chance that you get a rally in commodities, but then that puts the pressure back on the inflation narrative, which you'll see value stocks go up and a lot of your growth stocks come back off again. So you just got to watch the narratives around here, okay, coming into next week as well, and what changes. So company reporting so far, the banks have been fairly mixed. In a lot of cases, the banks' earnings have been revised down anyway. So don't listen too much about these beat or miss expectation because at the moment the market's pricing these banks a lot lower anyway. So one would think a lot of these lower revisions were already priced in. The banks, from a PE point of view, while they seem cheap at the moment, but let's see what the full update looks like, and what the future PEs look like over the next couple of months, over the next couple of weeks, as we start seeing a lot of the big analysts revise their views. So really, for now, I'd be still sideways these banks, okay? And with a question mark on whether this is the bottom for the banks or not. I think we'll find the answer to that next few weeks as we start seeing, like I said, the big analysts revise their views. Okay, start seeing some buy recommendations come out of the big analysts, then you might have an answer there, because they have fallen off considerably compared to where they were. But in this environment, okay, anything's on the table. Once again, that key bit of news next week is going to be telling. Okay, are we going to be in a recession? How bad is that recession going to look like in the US? In Australia, we're probably going to avoid it for now, okay? But with all these commodities crashing, there might be one around the corner. So we just got to keep that in mind. So where's the bottom of all this, guys? I still sort of remain in the view that we need to see the top of inflation and we need to see the top of this rate hiking cycle. We might, I think we'll see the central banks quickly find a rate slightly higher than neutral where they can just sit tight for a while. But the rhetoric is going to have to remain hawkish until a time where the central banks of the world feel like they can stimulate again, drop interest rates without driving inflation. And the only way you fix that is by fixing the supply chain issues, which is way out of the central bank's control. So only way out of this, guys, really long term, if we want to find a true bottom and a really bullish market again, we're going to be looking for inflation to come off and some confidence around the supply chain. So that way the central banks can backpedal a little bit and potentially talk about dropping interest rates. A bottom will be found, I think, sooner rather than later. But a bullish market's a way off. Okay, so I think we'll find the bottom in the next 2 to 3 months, if not even sooner. Okay, depending on what the Fed says next Friday, I should say. But nonetheless, the bottom will be found, I think, sooner rather than later. But I think we're going to stay low for a while. I think we'll whip around in a range towards the bottom for a long period of time. I think we'll see an extended period of time of sideways, as there's going to be a lot of uncertainty around inflation for the rest of this year. You're also going to have the midterm elections later this year in November for the US as well, which is going to create some uncertainty. But then after we clear through all of that, I think we'll come back into some bullish times, soon after. The big thing is going to be inflation, guys. So where's the bottom? It's not here yet, guys. I'm not prepared to call it, but I think we're not far off it. And if anything, the S&P 500 could fall another 10% down to about 35. And as long as inflation starts coming off soon, I think that'll be about it. If inflation's stubborn and the central banks remain extremely hawkish, hold on, guys. Okay, there could be a lot more to the downside. So there's no way of knowing, right? I listen to a lot of commentators say a lot of different things. There's some doomsdayers out there. I'm probably not really gone that far. I actually don't think there's much more left in this. But when you listen to the doomsdayers, they also have a good point. Okay, and it's really in these types of markets, in these bear markets, don't assume where the bottom is. Okay, you got to stay nimble. You got to be able to change your view at a moment's notice with these types of markets, because all it takes is a catalyst. Russia could escalate the war tomorrow, and crude flies back up, inflation narratives back on, markets crash off, right? So anything can happen. So right now it's not about forecasting where the bottom is. It's about being aware of what factors are playing out and keeping an eye on the market narrative. Okay, what is the current narrative? That's the constant thing you've got to be asking yourself. All right. At the moment, the market's just grinding sideways because there isn't a strong narrative. Because we know everything. We know the CPI reading in the short term last week was higher than expected at 9.1, but most people believe that's going to be the highest reading you're going to see. So they believe inflation's topped out, but they also believe the Fed's likely to continue to raise rates over the next few months. So what do you do now? The market's already fallen quite a bit. It's possibly priced it in. It's priced in the news that we know so far, and we're waiting for that next catalyst. Okay, so the current narrative is sideways, waiting for the next catalyst, and then from there we're going to try and find a theme. All right, is it going to be buy back into tech and discretionary because interest rates probably won't go much higher and it's time to buy back in? Will the earnings season prove to see that the earnings of some of these stocks like Netflix tonight isn't as bad as we thought, and then all of a sudden you see a bunch of buying back into that space? There's no narrative right now, guys. We're looking for the next narrative, and I think the market's consolidating, waiting for that next bit of narrative or the next theme to come out. So you've got to watch out for that, okay, and be ready to trade. Okay, so that's where we're at. Thanks for listening in today. Yeah, hopefully we'll have a bit more news in a week's time. But for now, markets are pretty boring and just waiting for that next trade idea. All right. Okay. Thanks. Bye for now.